long-term investing in a short-term world. What do you need to do? I can't emphasize enough. It's really more about what you want long-term outcomes.
This is the day and age now where everything is instant and fast. People's emotions can either be a helper or be a detriment. When you're thinking long term, you have to have the ability to put emotions completely to the side.
Welcome to another edition of Wealth Strategies Unleashed with Concenture Wealth Management. I'm Robert Gilliland.
I'm Karen Hyder.
Karen, I think the only way to start, like we kind of started this bit of a tradition, which I'm not certain is going over very well, at least not with me, but it is enjoyable. Is Karen's comedy? What'd you call it?
Karen's Comedy Corner. Is it too much of an alliteration?
All right, so let's deviate and move over there to Karen's Comedy Corner.
Okay.
What you got for us this week?
All right, I got a good one. Ready for it?
We will be the judge.
Okay. What is it called when a dentist pulls the wrong teeth?
I don't know.
An accidental procedure.
Oh, that.
At least you caught this one faster. There's been an episode recently. It took you a little bit longer to get.
I'm not sure. Oh, I don't even know how to segue on that one. So let's just go ahead and get into it.
Fair enough.
We've had quite a few conversations here recently with some relatively new clients, and that as we kind of started those conversations, it's really interesting that people bumped in. We've had these conversations. How many times can I say conversation here?
A lot.
Where they've said, I'm a long-term investor. I take Warren Buffett's mentality. And, one of the things that kind of occurred to me is that a lot of people have this philosophy of long-term investing in a short-term world. What do you need to do? How are you? So let's talk about this long-term investing kind of strategy, right?
Well, before we even dig into that, I think it's important to clarify what long-term actually is. This is the day and age now where everything is instant and fast. You can get on your phone and deliver something, it's there 2 hours later. You can call for an Uber and it's there in 5 minutes. What do we mean when we're talking about long-term?
Well, that's really interesting. When I'm talking with clients about long-term, I'm talking about projected needs in the future. Call that greater than 5, 10 years, somewhere right around in there. But I think in the context of people saying, I'm a long-term investor, they're basically saying, I invest in investment 1, 2, 3 or XYZ or whatever you want to call it, and then I'm going to hold on to that for forever, right? And I think that there's a real issue with that. What's amazing is that who's the most famous long-term investor ever?
I was going to say Warren Buffett,
Boom,
but you're making me
that's
think
the same
it's not.
one that I was thinking about is Warren Buffett as most people say, I take the Warren Buffett approach, right? Well, Warren Buffett's approach is not that he's a long-term investor. Warren Buffett's approach is that he buys companies that he understands and he knows and undersees where there's value, right? And he holds those companies not for forever.
True.
Berkshire Hathaway, Warren Buffett, absolutely a huge investor in Apple. However, recently he sold 390 million shares.
Yep.
And that is before earlier this year where he sold an additional 115 million shares. Now, recently in the news, Warren Buffett was reported that Warren Buffett was reducing his position in Bank of America. Well, he has sold 104 million shares just in 2024 so far. That's $1.5 billion worth. Okay? Now, what's interesting about that is that in 2023, he increased his position by 22 million shares.
In Bank of America?
In Bank of America. So here's the deal. Warren Buffett, being a good long-term investor, doesn't mean I buy a company and go away.
Yeah.
What that means is that I buy a company, and when the value has been maximized, I look for my next opportunity. Right? When valuations are completely out of... Now, the thing is on both those companies that I think that if Warren Buffett was here, and what he would say is that those are 1 and 2 in Berkshire Hathaway or in his holdings, if you will. And He's realized a huge gain, and he is looking to diversify. They are still number 1 and 2, and he hasn't gotten completely out.
Yeah, he's just trimming them down.
That's right. And so I think as you're thinking about being a long-term investor, and the greatest long-term investor of all time being Warren Buffett, that doesn't mean you buy a company and never ever sell it. What do you think as you're going through and you're thinking about this? And we kind of talked about this because there's how do people's thinking about money affect their ability to be a long-term investor?
Oh gosh, you're talking about the emotional side of things. I think people's emotions can either be what's the right word here? Either be a helper or be a detriment to them when you're thinking about long-term. So often people allow their emotions to impact their financial decisions that they're making that can completely derail a decision. So I think when you're thinking long-term, you have to have the ability to put emotions completely to the side and look at things from a number standpoint, from a fundamentals, from a technical standpoint, and from a standpoint of where it fits in your overall investment plan.
Yeah, I think that if you have a solid plan in place, it's very easy to be unemotional about your investing.
Yep.
Right? Owning stocks, owning bonds, having cash, possibly having alternative investments, those types of things. Having a strategy for where you go and do it really allows for you to focus on the long term, which is really what are your outcomes, and take advantage of short term. So how would you go through to take advantage of short term in order to help build out your long term?
Well, I think when I'm viewing short-term versus long-term, I think the key there is I actually start with the long-term first. So start with the strategic approach. So how much should you have within each allocation of your investments? That's kind of your strategic foundation. But then I think what you're talking about when you view short-term is more of a tactical move. So what kinds of moves can you make within your allocations that can help you find areas of opportunity that are more short-term, whether that be we really like energy right now. So is that trimming down another sector that we don't like and increasing energy for this short-term period where we see there to be opportunities? That's just one example that I view of how you could capture something in the short term that will benefit a long-term investor.
The other thing is having a disciplined process to dollar cost average. In other words, buy at a systematic rate or dollar amount or percentage amount over time. Right? If you're gonna go and invest in XYZ investment, it may not make sense to put all the money into XYZ investment, to put a portion this month, a portion next month. That way those fluctuations can actually come through and hit you. You know, the thing that's interesting, and then this is kind of circling back, so this conversation will probably be a whole bunch of loop-de-loops
Probably.
as we go through, is that, a lot of times people will have relatively short-term gains and not be willing to realize those gains, which in fact can turn around and affect their overall long-term growth, right? And so I think that you have to have a strategy in place that if you're taking individual stock risk, the toughest thing to know is when to sell.
Oh, yeah.
Right? But just because you might sell, you buy a company at 10 and it goes to 20, it might make sense to sell that company at 20. That doesn't mean that you take that cash and go and put it underneath the mattress. It means that you redeploy that someplace else. That kind of leads to how often should, in order to be a true long-term investor, how often should you evaluate your portfolio and think about making adjustments or allocation changes?
I don't know if that's a set answer. I think that depends a lot on your situation if you're working with an advisor. I know often we are looking at things on kind of a quarterly basis to see where changes and tweaks need to happen. I think there is a concern with doing it too often, meaning day trading or even weekly trading. If you're that focused on making changes that frequent, then you're often going to miss opportunities that you would get by staying invested in something and seeing it out for a little bit of time. So I would say at the earliest, maybe quarterly or sometimes even monthly can make sense. But quarterly is often what we focus on. I think you can stretch that out farther depending on what situation and where you are in life. What are your thoughts?
Yeah, I think I think it's the thing that we do inside there is that, yes, we review them quarterly, but that doesn't mean we're selling or buying quarterly, right?
Yeah.
A lot of times in our investment committee, as we're going through, is that we're trying to evaluate, is our premise or the rationale for making that investment still intact? Mm-hmm. If the answer to that's yes, then we're going to maintain or whatever with that position, right? And so it is, I do think that making periodic adjustments probably needs to be reviewed on a quarterly. We do ours quarterly, but if something were to happen, we would clearly do it earlier. But at least on an annualized basis, be sure to do a deep dive on that allocation and whether and what it is that we're trying to accomplish for the long term.
Well, especially because a lot of investors have assets in different places. If it's someone that is still working, well, they likely have a retirement plan through their employer, say over here, and they've got possibly assets in other accounts over here. So reviewing them at least annually to make sure that you don't have too much overlap in what you're doing and you're viewing everything from one picture holistically makes a lot of sense.
You know, it's very interesting. You brought up 401k, and I think this is the place that we bump into because it's a significant part of people's net worth.
Absolutely.
Right? And we've bumped into quite a few people who, for lack of a better term, trade their 401ks, right? And what's really interesting is that at the end of the day, they actually were a detriment to it, right? And so what's more important, and by the way, a Nobel Prize was given to that, given out for time in the market is more important than timing the market. And it's really interesting that people don't necessarily so what I mean by day trading or trading too much in their 401k is that they may go and invest in this mutual fund or this company, their company stock, and then it goes up and then they turn around and they sell it hoping to go back and buy it back because they found the secret sauce of what happens with that. Yep. Inevitably, they'll end up missing a dividend or they'll end up affecting future planning opportunities when it comes to accessing that capital for retirement in this case. Yep. And I just think that it's, you gotta, your 401k, you can't neglect how that's managed. Yes, those are long-term funds. That doesn't mean that you don't tweak the allocation or change which investment you're in, but be smart about that because it's really, if you're a long-term investor, that means you have a long period of time for this too. If we were all long-term investors, we would never, ever, ever own a large cap stock.
Why?
In the long term, small caps outperform large caps. So we would be nothing but small cap stocks. When was the last time you saw a portfolio that was overweighted in small cap? I'll help you out. Never.
Yeah.
Never, right? Especially like a 401k. If you were truly a long-term investor, you would put everything in small cap. Why don't people do that?
We don't have the risk tolerance for that. Yeah.
That's right, risk. Because you may end up going 5 years of significant underperformance for that one. So this whole idea of long-term investing, I can't emphasize enough, it's really more about you want long-term outcomes. That means that just like the rocket ship that goes to the moon, there's a million different changes that end up, course corrections that end up needing to happen. You can be a long-term investor and make adjustments.
And I think like you said, and a strong point to make is the long-term outcomes. What's crucial to have that happen is to have consistent, steady returns. Your long-term goal is for growth and to reach certain outcomes. In order to get that, it means not trying to chase the next hot stock that you've heard of on TV or from a friend. You're not making emotional decisions and seeking these crazy investments. You're focusing on good, strong companies. You're maintaining the investment allocation that you've set forth as right for your risk tolerance. And you're viewing things with a steady growth projection and a goal of steady growth to meet those long-term goals that you have in place.
Yep, and I think I go back thinking about this long-term is that you go through and you think, being in Houston, Enron. In 1995 and 1996, 1997, 1998, there were 1999. There are a tremendous number of long-term investors in Enron.
Unfortunately.
And when the stock was at 80, they were really, really smart and they were bragging at cocktail parties. But when it was at 17, they didn't want to sell it because they were long-term investors.
Yep.
At 0, they would have loved to have it get out of it at 17. And that's why you can maintain long-term, but you need to go through to make adjustments. What other thoughts do you kind of have on this kind of short-term long-term investing in a short-term world?
We've hit on the big ones I had. So making sure that you are viewing things long-term to maintain a smoother approach, minimizing your emotions for sure. I think one other thing that we often talk about around here is utilizing times of volatility to your advantage. Meaning, if you're a long-term investor and you've got 10 or more years, even sometimes 5 or more years for a certain outcome that you're trying to reach, when there are pullbacks in the market or corrections that happen, viewing that as an opportunity to redeploy or to invest cash that you have on the side, viewing those as buying opportunities for companies that are, for lack of a better term, on sale, the good, strong, fundamentally sound companies, buying into those during those periods of volatility just means that when that recovery starts to happen, you are now taking advantage and participating in that recovery. So viewing long-term investments and taking advantage of volatility without sacrificing other things, I think can make a difference.
I think you're exactly right. The last thing I would say on long-term investing is back in the 90s and early part of the 2000s, owning a company known as General Electric was a no-brainer. They had businesses everywhere, had a whole bunch of different things going on. That company's a shell of what it was.
Oh, yeah.
And performance on that has not been, you never hear it talked about in the financial press anymore. And it was a behemoth giant. They made jet airplanes. They made healthcare. They did finance. Now, I understand that they've spun and sold those different businesses, but it's nowhere near the shell. It's nowhere near the GE that was, my advice to you, son, is just buy GE and hold on to it forever. That's not you have to be prepared to make those changes. Working with an advisor to make sure you understand the risk that you have and being able to adjust it. And making adjustments doesn't mean you're not a long-term investor.
Exactly. Yeah, making smart adjustments.
Well, awesome. I just want to say thank you for listening. I think we've covered it today, right?
Yeah, we did.
Thank you for listening to this podcast. If you have any questions, please feel free to reach out. We're here. We look forward to seeing you all next time.
See you next week.
The information contained herein is intended to be used for educational purposes only and is not exhaustive. Diversification and/or any strategy that may be discussed does not guarantee against investable losses, but are intended to help manage risk and return. If applicable, historical discussions and/or opinions are not predictive of future events. The content is presented in good faith and has been drawn from sources believable to be reliable. The content is not intended to be legal, tax, or financial advice. Please consult a legal, tax, or financial professional for information specific to your individual situation.
This work is powered by Concenture Wealth Management, registered representative of Sanctuary Securities, Inc., an investment advisor of Sanctuary Advisors, LLC. Securities offered through Sanctuary Securities, Inc., member FINRA, SIPC. Advisor services offered through Sanctuary Advisors, LLC, an SEC registered investment advisor. Concenture Wealth Management is a DBA of Sanctuary Securities, Inc. and Sanctuary Advisors, LLC.